This is that ice cold Michelle fight for that white gold. This one for them hood girls, them good girls, straight masterpieces.
And good morning. Welcome to the show. Take your questions and comments here. 281-558-5738 is the number if you want to call in this early. Get by the website, realinvestmentadvice.com. Of course, we have our new blog post out this morning talking about 1995. And, you know, lately there's Donald Trump. We just talked about this last break. Donald Trump's been going strongly after Jerome Powell. Saying that he's not doing a good job, and if he would just cut rates and do more QE, that it would be great. And we would have a booming economy, and the markets would be dramatically higher. And it's true, right? I mean, if we cut rates and we started QE again, yes, asset prices would most likely rise higher, and you would probably create another leg of the bull market temporarily. But, you know, the issue is interesting because when you look back at 1995 as an example, and this is really what the case has been made for the markets today. But there's some interesting juxtapositions. There was a tweet that was sent out, and it says, Powell stated an ounce of prevention is worth a pound of cure. That implies the Fed's going to with insurance cuts like in 1995, which it successfully prevented a recession. Well, there was no threat of recession in 1995. 1991, we had just gone through a recession. We were actually in the recovery of an economy. The Fed had hiked rates, and the Fed did do an emergency rate cut in 1995, not because of threat of recession, but because of a threat to the potential member banks of the Federal Reserve from Orange County going bankrupt. What the Fed was concerned with in 1995 is that the debt default of Orange County was large enough that it would impact the financial banks of the country because of the default on the debt. So they cut rates. But very shortly, Orange County kind of passed through the system. No big deal. The Fed hiked rates back to where they were. Of course, the economy is booming at this point. We're just in the midst of the internet boom, right? The internet has just now come mainstream. Everybody's going online. Little company called E-Trade just really coming of age. People, you know, trading like crazy online. You know, it's interesting. In 2000, about 80% of all investors in the market in 2000 had made their first investment in 1990. About 80% of that 80% had made their first investment between 1995 and 2000, right? And that was the advent of online trading. The internet brought the Wall Street casino to every household in the country. And we saw a lot of activity there. Of course, .com stocks are flying higher. You know, it's the market seemed unstoppable at that point. If you're investing like Warren Buffett, that was like driving Dead's old Pontiac, was one of the quotes back then. Why buy value? Buy .coms. You know, what's interesting is people come back and they talk about that period and they say, well, you know, wow, look, the Fed cut rates and you had this booming stock market. Well, you had some very different environments. You know, every environment is different, but you had some very different circumstances between 1995 and 2000. But the one thing that people forget is that while they're championing this cause of surging bull markets, right? Sounds great. Well, the problem is, though, is that the ultimate crash, which occurred from the inflation of the market at that point, the exuberance, right? It wiped out all the gains between 1995 and 2000 anyway. So effectively, if you just bought bonds, which were paying about 8% at the time, CDs at the bank were paying 8% in 2000, just mind you, okay? If you just bought a CD or a bond, you vastly outperformed the market during that period of time. So it's great to talk about chasing stocks and being invested as long as you know when to get out. And most people didn't, right? They ran the whole thing up to the top. They ran it all the way back down again. And then they ran it back up to the top in 2008 and ran it back down again in 2009. And that's why really over the course of the last 20 years, markets really haven't made a whole lot of progress for most individuals. And we can look at the financial statistics across the country and we can tell you that that's a fact. buy low, sell high doesn't work for most people. It's mostly the reverse. People buy high and sell low. But the point is there's some other big issues that are different. In 1995, as an example, personal income was averaging about 4%, rising to 5%, by the way, on an annual growth rate. Employment averaged about 2.5% annual growth rate and was solid heading into 2000. I mean, very steady. Industrial production averaged about 5% annual growth, was rising in the last few months of 1999. Real consumer spending was rising strongly heading into 2000 as well, averaging about 12% annually. That's inflation-adjusted consumer spending was averaging about 12%. Real wages were climbing steadily from 1991 to 1999, hit a peak of almost 14% annual growth in December of 1999. Now, remember, this is December of 1999, right? Now, if I told you that real wages were growing at 14% annualized, real GDP was running at more than 4% in 1999, employment was steady at 2.5% growth, and personal incomes were 4% going almost 5% in 1999, you would tell me that there's obviously no chance of a recession in the economy in December of 1999, wouldn't you? I mean, that would just make perfect sense. If you looked at that data, you'd say there's absolutely no chance of a recession. Yet, just a few months later, not only were we heading into recession, we were in the middle of a dot-com crash. Let's take a look at some of the economic data that we have right now as compared to then. Personal incomes today average about 2% annual growth versus 4% in 1995. Employment's running about 1.5% annualized growth versus 2.5% in 1995. Industrial production is averaging about 2% versus 5% previously. Real consumer spending is averaging about 4% versus the 8 to 10% in 1995 and the 14% in 1999, 4% annual growth on inflation-adjusted basis. Real wages are averaging about 3.5% annual growth versus 8 to 10 in 1995 and 14 in 1999. And real GDP is averaging about 2% annual growth over the last decade versus 3% previously. So if I gave you that statistics, I said, look, this is 1995 all over again. You go, no, it's not. And you're right, it's not. But just like 1999, there's absolutely no evidence from the economic data that I just gave you that recession's anywhere in the cards. I just want to remind you, in 1999, it was exactly the same thing. The Fed started cutting rates pretty aggressively in 1999, and that was really the precursor to the recession at that point that occurred, of course, the dot-com crash. Here's another big difference between today and 1999. Government spending makes up a big chunk of economic growth at times. In 1995 and heading into 1999, the budget deficit in 1995 was running about $250 billion. Budget deficit. By 1999, it was actually positive. We actually were running a positive surplus. And that had a lot to do with the fact that Clinton borrowed $2 trillion from Social Security, stuck it into the federal coffers, and reversed the deficit temporarily. But nonetheless, the deficit was small to positive. But here's the interesting thing about this. There is what's called the federal disposable income. Federal disposable income is what the government has left over to spend after they bring in tax revenue and transfer income from sources, and they spend out on social welfare and transfer payments, in other words, mandated spending, they have a leftover balance, right? So if you take that leftover balance, they should have some discretionary money to spend on other stuff like social service, like defense spending or whatever. From 1991 to 1995, the federal disposable income grew from about 150 to 250 billion to almost $600 billion in federal disposable income in 1999. Today, the federal disposable income is negative. In other words, we spend more on social welfare and transfer payments than we bring in revenue. And we're running nearly $1 trillion deficit versus a surplus. Now, why is that important? If we take a look at economic growth less government spending, right? So when we look at the GDP, the economy, right, we have personal consumption expenditures. That's you and me. That's about 70% of the economy. We have imports and exports, what we import versus what we export. And we have what's called net exports. Then we have business spending, right? We have corporations that are doing capital investment, things into the country that's creating economic growth. But then there's also government spending. Government spending is part of money that flows into the economy, right? Okay, so if we go back and look at the 1990s, let's take economic growth in the 1990s and let's subtract out the impact of government spending. If we look at that period of time, the economy grew at almost between 4 and 5% less without including government spending, right? So government spending just added to that. If we subtract out government spending today, and yes, you hear all these economic statistics, right? There's like, economy's growing at 3%. It's great. Ever since Trump got elected, the economy's booming. Actually, the economy's been in a recession for the last 4 quarters if you subtract out government spending. And of course, that jives with a lot of the industrial production numbers that we've seen, core capital goods orders, etc. Yes, government spending is part of what drives the economy, but what we really want to know is how organic is that growth? In other words, if you subtract out government spending, how organic is the growth of the economy? It's actually been negative for 4 quarters. And the reason that's important is that when the Fed starts, cutting interest rates and doing these things, it's typically in line with an economic recession. If we look back historically, when government spending is extracted out of economic growth, whenever that number goes negative, which by the way was in early 2000, it was just prior to 2007, about mid 2007, that number went negative. And today, ex-government spending, this has been a great indicator of upcoming recessions and why the Fed starts cutting rates because of the impact of what's happening in the economy. And we're seeing that again today. Now, when we come back from the break, though, I'm going to tell you why I'm going to make the case that there's potential for a higher leg in the market. But then what happens next? That's coming up right after the break. I'm your host, Lance Roberts. Don't go away.
Catch Lance Roberts' podcast later at lancerobertsshow.com.